Good morning. Welcome to Stock Market Today. It's Wednesday, October 16th, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today, where you can sign up for a free email to get daily stock ideas for you to consider in your inbox every trading day before the market opens. So U.S. equities finished higher in Tuesday's trading, ending just off the best levels of the day. Move higher was largely a function of the initial round of earnings reports being well received by investors. Heard from a lot of the big banks yesterday. Additionally, recent data from the B of A Merrill Lynch Fund Managers Survey showed cash at extreme bear levels. So when we hear the, dry powder, it's there. Treasuries were weaker across the curve. The dollar was weaker against sterling, but stronger against the yen. Gold was down 90 basis points. WTI crude down 1.5% on the day. As we get to the desk this morning, futures are down about 20 basis points after that big rally yesterday. No big directional driver in play. People still focused on earnings, as they will be for the next few weeks. Treasuries are seeing solid gains with the curve steepening. Dollar is unchanged against the euro and yen. Gold is up 30 basis points. Crude oil up 60 basis points to get things going on a Wednesday morning. Here's the chart of the S&P 500. It pushes to the top of the resistance zone. Remember, we've been highlighting 2950 to 3000 as resistance. Well, we tagged it yesterday and closed near that level, closed at 2995, and resistance is near that 3000 level, maybe pushes a little bit above it. But for the most part, round number resistance around 3000 has held. Key support is at the 200-day moving average near 2858. It's a rising 200-day moving average. We've been updating this number daily. But the really important level is 2820, the low end of the August trading range, right? So for me right now, it's pretty clear that the market is in a well-defined range. Call it 2820 on the low end, call it 3020 on the high end. That's 200 points wide. For those of you who are thinking about where the market could go if we break one way or the other, add 200 points to an upside breakout, subtract 200 points from a downside breakout, and you have likely price objectives for the S&P 500 if and when we do break out. RSI holds bullish ranges at 57 now, continuing to move higher. Chaikin money flow does remain on a bearish reading. However, we'll see if we can get some a quick turn. If it's just a quick dip and back into bullish territory, it's something obviously we are going to be watching very closely. Turning to our market in a minute now. What am I writing about in my note to Chaikin Analytics clients today? Well, stocks rally as bank earnings highlight a resilient consumer. And that was the key takeaway from all of the bank earnings. The bank earnings themselves were a mixed bag. JP Morgan, the standout to the positive side, though all of the stocks did trade higher on the day with a risk on type move in the market, and a lot of commentary about the resilience of the consumer in spite of recession fears starting to impact business spending. As we said, S&P 500 and the SPY pushed to the top of the recent trading range. Sentiment is mixed this week. It's Wednesday. We look at our sentiment indicators, but still more fearful than greedy. So add that to the fund managers survey, and you have a potential tailwind for an upside breakout. Healthcare was the leader on the day, but pharma remains a bearish group. We'll take a look at that, and futures do point, as I said, to a lower open here today. Power bars for the major indices: the Dow 5 bulls to 8 bears after a 90 basis point lift yesterday. S&P 500 adds nearly 1% and improves the ratio, 115 to 94 bulls to bears. NASDAQ stand out on the upside, 1.26% to the good, 2315 bulls to bears. Small caps, small outperformer on the day, 570 bulls, 366 bears there. With the risk on rally in equities, bonds came under pressure, sending yields higher. Remember, we started to look at that chart of the 10-year yield on Monday and pointed out what could potentially be a bottoming process. Another one of the standout groups yesterday was Comm Services, up 1.7%. 6 bullish stocks in that group for 3 bearish stocks. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain somewhat bullish. Major indexes across the board, however, are mixed. Let's hit our stock of the day now. Auto-generated by our algorithm based on the power gauge rating. It's Medtronic. MDT is the ticker symbol there. Closed at 108.19 yesterday, up 58 basis points. So call it a slight underperformer in what was otherwise a strong healthcare tape. Shaken power gauge rating for Medtronic is very bullish due to very strong earnings performance, very positive expert activity, strong price volume activity. So 20 factors, 5 in each of these categories, give us a very bullish rating. Trend is strong as the stock is above a rising long-term trend line, but the healthcare equipment and supplies industry group is a weak industry group when we look at that power bar ratio. And we do have a bit of a mixed bag here when we run through our analysis. Our very bullish rating is met with an outperforming stock. However, we're closer to overbought than we are to oversold. And shaken money flow is dipping into bearish territory. So Medtronic it's an in-between stock right now, really, right? I prefer strong stocks and strong industry groups. So the weak industry group gives me some pause. The weak money flow does give me some pause as well. And the fact that we're closer to overbought than to oversold from a tactical standpoint, especially with the market now near-term overbought, I think you can wait on Medtronic. I think you want to add Medtronic to a bullish watch list and keep an eye on it. If relative strength, if money flow improves, then it becomes a little bit more of a compelling idea on the long side of the portfolio. Taking a look at the sector tracker now, movement of the major sectors over the last 5 days. Those strong bank earnings drive the fins to the top of the list. Joined there by technology, which continues to do well. Remember that technology is a large weight in the index. So bullish investors want to see tech continue to perform well, but just be mindful of the rotation. We've talked about it here for a few weeks. Investors continue to rotate out of the high multiple software names and into the semiconductors. Industrials and materials are your trade sensitive groups that are trading higher over the past 5 days. Energy looking like a counter trend bounce within a pronounced downtrend. Comms, healthcare, and discretionary are middle of the road. Your underperformers are your defensives and your bond proxies, right? REITs are up over the past 5 days, but lagging. Staples and utilities are down over the past 5 days. And as we've been talking about now this week, starting on Monday when we started to highlight those yields, if yields are bottoming and then beginning to gain traction to the downside, that would be a headwind for real estate and utilities. And to the extent that we get more risk on type trading in the marketplace would obviously be a headwind for the defensive consumer staples. Now, speaking of technology and being selective about where you're looking for ideas, our industry in focus today is innovative technology services, which has been an underperformer over the past 6 months, lagging the S&P 500 by nearly 6.5%. And its power bar ratio, which measures future potential, is weak. 31 bearish or very bearish stocks here for 17 bullish or very bullish stocks. Ranked number 16 of 21 subsectors. Some of the indicative names there that you want to avoid because they have very bearish shaken power gauge ratings are Lending Tree, TREE, Interdigital, IDCC, and IQ, ticker symbol IQ, all with very bearish ratings. And here's what we're talking about within the technology group. Right? You want to find stocks and charts that look like the semiconductors and not innovative tech services or software. This fund has a bearish shaken power gauge ETF rating, and the trend is weak as it trades below a declining long-term trend line. Notice that it has been underperforming the market since late July, early August. Right? This went from a strong outperformer to now underperforming. This is a personality change within the technology sector, right? This was a darling of the group for most of 2019 up until August when it began underperforming, and now the rating has turned bearish. At the same time, the fund is overbought and shaken money flow is, let's call it mixed. I can't say it's persistently bullish or bearish, but this is an area of the market and an area of the tech space that we want to avoid. Let's hit our movers and shakers now. Yesterday's S&P 500 gainers and losers. Nectar adds 9% on the day, but what's interesting to me is it actually traded at a 52-week low, so a big reversal for this volatile name. United Healthcare reports earnings that sent that stock higher by 8%, and that helped out Anthem and Cigna, both up on the day. Anthem up 6%, Cigna up over 5.5%. FRC reported an earnings beat to send that stock higher by over 6.5%. So now as we start to get into the heart of earnings season, we're going to see a lot more company-specific news as well as the derivative plays, right? United Healthcare reports good earnings, and investors immediately start making the read-throughs into Anthem and Cigna to send those stocks higher. On the loser side of the board, XEC No real news there to send that one lower by 2.6%. Cody COTY, part of that consumer staples group that was under pressure, 2.5%. ConAgra and Hershey are food stocks, and both of those stocks were lower as some Nielsen data started to show some weakness or weaker than expected numbers in and around the food companies. So they were under pressure yesterday. PG, Procter Gamble, consumer staple stock under pressure as there was a risk on type bid to the market yesterday. PG down 2.37% on the day. Let's dig into the charts now. I told you it's sentiment day on Wednesday, and the sentiment indicators that I look at have turned mixed, but are still more fearful than greedy, right? And you can kind of see that here. If we look at the 13-period moving average of the CBOE put call ratio, we can see that it's still elevated. Didn't quite get up to that extreme reading of 0.75, but it is still elevated. Investors are still gravitating towards put options to either bet on downside or to protect their portfolios. And we combine that with the data point that we received from the Merrill Lynch Fund Manager Survey, where cash levels are towards the higher end, almost towards a bearish extreme. To me, sentiment and positioning in that regard could provide a tailwind for the market going forward, especially in light of the fact that breadth remains strong. But the reason I say sentiment's mixed is because we've had a spike lower in the VIX here. Take a look at the VIX getting back down below that 14 number. So not quite as fearful as we were last week, but still more fearful than greedy from a sentiment standpoint. One other data point that I look at and I write about in my note to Chaikin Analytics clients is I take a look at the CNN Fear Greed Index, and that it saw an improvement on the week. Last week it was at a reading of 29. This week it's at a reading of about 42. So still in a fear position, but less of a fear position than we saw last week. Now, as we said, pharma is a bearish group, right? Healthcare had a big day yesterday. Strong rally, was one of the strongest sectors in the market. And you can see the spike that pharma had yesterday. But from a trend perspective, which is where I focus most of my attention, this group is still bearish. XPH is the SPDR S&P Pharmaceuticals ETF, and we can see a clear downtrend below a declining 200-day moving average. All the while this fund has been below its 200-day moving average, the RSI has not been able to become overbought on rallies. So that gives you a clue that the momentum to the downside is strong, right? We're not seeing spikes to lead us believe that the trend is changing anytime soon. Additionally, look at the relative trend. XPH relative to the S&P 500 in a clear downtrend for the better part of the past 12 months. No real signs of abating there just yet, especially when we consider the fact that XPH has a bearish ETF power gauge rating at Chaikin Analytics. And when we look at the ratio of bullish to bearish stocks, we can see that there are 12 bullish stocks for only 6 bearish stocks. So a 2-to-1 ratio in favor of the bears leads us to believe that the pharma names are likely to remain an underperformer. So as the market starts to do better, starts to potentially lift up and through resistance, if that was to play out, we want to focus on the areas of the market that are leading, right? We want to focus on the areas of the market that are outperforming. This, along with energy, are not the areas of the market that have been outperforming. So we want to continue to avoid those. And if you're looking at individual names, I mean, this is an icon of the pharmaceutical industry. It's Pfizer, ticker symbol PFE, has a bearish rating at Chaikin Analytics. And if we just analyze the chart here, what we could see was a clear breakdown through support, which is now resistance in the 38 to 39.5 zone as the stock trades below a declining 200-day moving average. Notice how deeply oversold it became, giving you a clue as to how strong that momentum was to the downside. And for now, we are hanging tough in bearish ranges for the RSI as the stock remains below resistance and continues to underperform the market. Pfizer This lift here may give you an opportunity, if you own it, to take some money off the table. If you do trade to the bearish side, maybe look for some potential opportunities there. That'll wrap it for today. ChakinAnalytics.com/today for that email. I'll see you back here tomorrow.